Today our discussion is about quality consideration and benchmarking, and that is Unit 17, responsibility accounting and other topics with it, that is transfer pricing, and this is Unit 18. Broadly we are going to discuss what is quality, what is the definition of quality, what is ISO, what is the cost of quality to the company, measure of quality and tools for the quality analysis, benchmarking, total quality management, ISO, responsibility accounting, allocation of common cost, transfer pricing, theory of constraint, performance measurement and the balance scorecard, and project management. Broadly, these topics are very in-depth in nature. For example, if we talk about total quality management, that is a complete set of subject. Then project management is again a deep sort of discussion we can do. But we have to confine ourselves for the CPA syllabus. So I will try to be in the defined parameters. Now, typically quality was not an issue 50 years before, 60 years before. You just want to make and sell. And if people feel that goods are okay, so they use it. But gradually, as the customer expectations were increasing and they were more focusing in terms of zero defects, and they want things to be similar to each other. It's not that one product is okay, other product is not working fine. So that was not a quality concept for them. So gradually the quality came in the operations, procedure, production, and overall in all the organization. So in today's lecture we are going to discuss what is quality, how it helps organizations, and then we will relate it with total quality management. That is the attempt to reduce the cost and increase operational efficiency in the business mechanism. Then we have to link it with the ISO, which are now everyone needs ISO certification, and they believe that if you are ISO certified, so your company is a standard company to be deal with the others. Benchmarking is when you compare yourself with the best practices. It may be your competitor, but it's not necessary that it should be your competitor. You can compare yourself to improve. If your standard is high and you are targeting to that standard, so means you will try to bring improvement in your procedure. For example, if a young guy, he idolizes Tom Cruise. So this is the benchmark. Tom Cruise is a benchmark, and he will now start thinking in a way, behaving, talking, hairstyling, coloring, his dressing. Well, gradually, one day he will look like a Tom Cruise. Same way, if you will develop yourself, same way, if you want to develop yourself as a big company, big practice, and good governance, corporate governance, you want to bring efficiency in your business procedures, you have to make a benchmark to follow. Because this benchmark is, if it is better than you, then surely you will reach to that place where you will, and if that benchmark is also having a benchmark, so it's a gradual improvement in your business mechanism. Because you cannot claim yourself that you are now achieved what you want and this is the dead end. Once you reach to a next stage, then a next stage challenge is waiting for you. That's why those candidates who do CMA, then they feel they should do CPA. After CPA, they feel they should, for continuous professional development, they should do this, they should do this. So the benchmark keeps changing. But once you reach to a higher stage, surely the benchmark will come to a next stage. Because that's why he is your benchmark, because he knows to set the benchmark, to go and make a trend for the best practices. So benchmarking is a technique for the companies for improvement, to bring efficiency in their business operations by having standard for best practices. Then we have the total quality management, which is to bring quality in all aspects of the business operations. And if you bring quality and value engineering in the business process, you will feel that your cost is reducing. So it's ultimately going to hit your cost, and you will achieve the highest level of cost efficiencies, which is surely going to generate a high profitability for you and the best value for the product design, research and development in terms of all operations. After this, we are going to discuss responsibility accounting. What is responsibility accounting is, before, when there was a concept of kingdom or centralized the empowerment power, the all decision making was with one guy, and all the rest are following it. This was the trend. But once the world realized that decision making will be more supportive if you involve the people, different minds, take their feedbacks and give due consideration to the opinions. You have to empower the employees for taking decisions. So if they know their parameters in which they have to work, and they know what is their domain of operations, and within that domain they can take the decisions, so his domain will be more efficient and effective. Because board and the senior management is not into day-to-day operations. Generally the middle management is into day-to-day operations. So if you want to bring efficiency in operations, the best approach is always to involve people in the decision-making process, give them empowerment, give them right to decide for the given circumstances. But this is not a general rule. It may be applicable to the good environment where people are more educated. They know when you give them power, they understand the responsibility also. But if they are not educated enough, they cannot take decisions. In that case, you cannot give the empowerment. And you have to see the person who are you going to give powers, delegate authorities, should be capable enough to perform his roles. Now, we have a CEO for the company. The company has different units. And for a single CEO, it's not possible that to take all the decisions. So it's now the need, it was a need of time that they should delegate their responsibilities to the general managers, assistant managers. This gives a concept of responsibility. What you do is you make profit center, you make responsibility center, you make a department and you say, okay, you are responsible for you. Sometimes you say you are responsible for your cost. Sometimes you are giving them a direction that you are responsible for income and cost. So it means you are making them profit center. Sometimes you are only making them responsible for income, this is income center, and sometimes you give them income, expense, means profit, plus whatever investment took place to build their department, also for the equity, so it will be an investment center. These are called SBUs, Strategic Business Units. Generally in everywhere, in all organizations, big organizations, whether they are FMCGs or they are banks, they are working on this concept of SBUs. They have their business units, which is traditionally been called as departments. But now the department has been upgraded with certain roles, certain expectations to the management. Because management is the process of planning, organizing, implementing, designing and evaluation. So if one guy is planning finance, marketing, sales, production, that is not going to bring efficiency. Efficiency will bring when the related, skilled, experienced person is going to develop his own strategic vision of the department and the directions and the procedures of the company, and which is supplemented to the organizational overall growth of the company. So in responsibility accounting, we will understand the concept of profit center, allocation of common costs. Some costs are common. Suppose we are a group of company and we have one head office, and there are 6 companies in the and they have 6 offices. How to allocate the rent on it? One company having 3 million turnover, one has 300 million turnover. If we divide the rent by 6, it is justified. Is it okay? Or we are going to put burden on a smaller company by putting a huge equal share. Maybe a new company is so new, and you are going to put the administrative secretary expenses to his profit and loss. So the financial controller of this company will be surely demotivated. He will say, we are 3 people, but we are paying the equal rent at this 36 people company is giving. So we have to see the allocation of the common cost should be very realistic, and it should be done in a way that should not affect the morale and motivation of the employees, and ultimately it should not distract the profitability of that particular company. Transfer pricing is the concept that when you give the concept of responsibility accounting, so each department treat the next department as a customer, because you are responsible for yourself. So you know your expense, your income, and when suppose we are in a textile environment, we have a spinning department, we have a ginning department, spinning department, weaving department, and finishing department. So once the fabrics, the thread will be developed, it will forward it to the weaving department, but it should be adding some margin on it. That is a concept of transfer pricing, because transfer pricing concept is how to transfer the price between one department to another department, because once you give them a responsibility role, so now he start thinking about that how to make money. Within the departments you have to see in this way, transfer pricing is not an easy job, because it's like you are charging something from your own brother. Because it's one organization, one department, and you have to take care that this price should not be demotivating, because your objective, his objective, all departments' objectives will be developing the organizational objectives. So if inter-conflicting objectives for each department will not lead to the success for the company. So how we do the transfer pricing, there are certain techniques we discuss. Theory of constraint is, as we know in economics, that human wants are unlimited, and we have scarce resources. We have scarce resources for that one, which leads to a concept of scarcity. Scarcity is a concept which says that the human wants, we have limited resources, so we have to choose how to use them efficiently, right? In this case, theory of constraint, we have to identify what constraint we have. There is an approach which we call it 80-20 approach. Suppose 80% we are correct, 20% we are incorrect. So we have to focus on this 20%. So we can remove the deficiencies, defects. So for any organization, it's very important that they should know what are their constraints. Some companies might have raw material constraints, some companies might have labor constraint, capital constraint, they don't have money, finances, and the country in which they operate is not a healthy country in terms of economics and growth. This constraint we have to identify. And there is a model called DBR, drum buffer room, that I will discuss with you. Performance measurement and the balanced scorecard. This is very important, very practical also. Generally, the group CFOs or the strategic analysts, they do this work, performance analysis. They identify the critical success factors of the company. For example, McDonald's is a very successful company. They are operating all over the world. People like them. and their products, they consider it as valuable. So what is the success factor behind that one? If we generally discuss what could be a success factor, someone can say it is a value meal, it's economical, and it's high quality, environment is okay, service is good, and any factor you can find out. But if you give this factor to some other company, will it be successful? This is the question. So where actual success lies, what are the critical success factors? So companies should focus, first of all, companies should know their strength, that which things make them successful. Then for that successful factors, they have to keep in mind that how to sustain and how to continue to be successful. So identification of critical success factor, that why you are a success, this is very important. Success management is another issue. And then on the other hand, we have to see the balanced scorecard, which we will see the financial measures and non-financial measures. Some people claim themselves as a big organization because they are operating in, say, 160 countries. Some they are only operating in one country, but still they claim themselves very successful because their success criteria is different from their success criteria. Their success criteria is having so many destinations in the world. But the other company, their success criteria is profitability. Turnover, they are saying what is your turnover out of 180 countries, 160 countries. My only one company turnover is 10 times higher than you. Then some people says, I have more than 100,000 employees all over the world. We are a successful company. But the other guy will say, we are only 10 people. What is your turnover? My turnover is better than you. So what is the need of this whole fleet? What success you are talking about, right? Some guy is proud to be the producer of some specific thing, which is sold everywhere. Some other entrepreneur is successful to sell exclusive items. Some people are selling normal goods, but in bulks. So some people recognize performance in terms of customer services, then the quality, and then there are 3-4 other issues. Means you claim yourself as a quality oriented company, your service is very good, and people recognize you as a good corporate company because your corporate practices are very good. So success, first of all, for all companies, you have to define your success. Then you have to see the financial measures and non-financial measures. And in the last, we have to discuss the project management, which is generally, as an investor, you have money and you have different project options with you. You can open a bank, you can make a finance house, you can make a hotel, you can make anything. So for that, if you choose something, how to choose between the projects, which project is good, how to plan a project, then how to execute, how to evaluate the projects, this is all into the project management.